Have you ever wondered how banks, especially digital ones like NorthOne, make money? It's a question that many people ask, but few truly understand. Today, we're going to dive deep into NorthOne's business model and uncover the secrets behind their profitability. NorthOne is a relatively new player in the banking industry, offering a range of financial services to small businesses. Their innovative approach and focus on customer satisfaction have garnered significant attention. But how does a bank that doesn't have physical branches generate revenue? Key revenue streams. Interest income. This is perhaps the most straightforward way banks make money. When you deposit money into your NorthOne account, they can invest it in various assets, such as bonds or government securities. These investments generate interest, which becomes part of the bank's profit. Fees and charges. NorthOne, like traditional banks, charges fees for certain services. These can include overdraft fees, charged when you spend more money than you have in your account. ATM fees, charged for using out-of-network ATMs. Monthly maintenance fees, charged for maintaining an account. Wire transfer fees, charged for sending or receiving money electronically. Non-interest income. This category includes various revenue streams that are not directly related to interest. Some examples include merchant fees, charged to businesses that accept credit cards through NorthOne's payment processing services. Foreign exchange fees, charged for converting currency. Safe deposit box rental fees, charged for renting a secure storage space at the bank. Investment banking services. While NorthOne may not offer a full suite of investment banking services, they could potentially generate revenue by providing advisory services to their business customers or facilitating mergers and acquisitions. The role of technology. One of the factors that sets NorthOne apart from traditional banks is its heavy reliance on technology. This technology enables them to reduce operational costs. By automating many processes, NorthOne can minimize the need for physical branches and reduce overhead expenses. Offer innovative products. Technology allows NorthOne to develop new products and services that cater to the specific needs of small businesses. Enhance customer experience. NorthOne's online and mobile platforms provide customers with convenient access to their accounts and services. Risk management. Like any financial institution, NorthOne faces risks. These risks can include credit risk, the risk that borrowers will default on their loans. Market risk, the risk of losses due to fluctuations in interest rates or other market factors. Operational risk, the risk of losses due to internal or external factors, such as fraud or system failures. Liquidity risk, the risk of not having enough cash or other liquid assets to meet its obligations. To mitigate these risks, NorthOne employs various risk management strategies, such as diversification, spreading its investments across different asset classes and industries. Credit scoring, assessing the creditworthiness of borrowers. Stress testing, simulating various economic scenarios to assess the bank's resilience. NorthOne's business model, while similar in some respects to traditional banks, is shaped by its focus on technology and its dedication to serving small businesses. By understanding its key revenue streams, the role of technology, and the risks it faces, we can gain a deeper appreciation for how this innovative bank operates. With that said, thanks for watching, and until next time.